Hello, everybody. My name is Martina Bozadzhieva, and I'm the Chief Research Officer at FrontierView. On behalf of my colleagues, we welcome you and thank you for joining this episode of GlobalView. This month, my colleague Elizabeth Russ, who is our Senior Analyst for Global Economics, and I will talk for a few minutes about some of the biggest global macro issues our multinational client base is grappling with. And there are a lot of them. Since Russia's invasion of Ukraine and the multitude of spillovers that we've seen on the global economy, the international environment has grown even more challenging for companies trying to navigate a strategy this year. Many of the assumptions that companies made so far for 2022 have been upended, in particular in Europe, but really from a global perspective across a number of markets, commodities, input costs, P&L implications. It's been exceptionally challenging. And so we're seeing our clients resetting targets, building new scenarios, trying to really anticipate where demand is going to go and what will happen to costs next. And so a lot of what we do is helping them try to navigate that uncertainty, build those scenarios, and set accurate expectations that they can align on with their teams. And today we'll cover a few elements of this picture. Probably not possible to cover everything, but we'll focus on three particular issues. Elizabeth, would you mind introducing us to the three topics we'll cover in today's conversation?
Sure. As you alluded to, lots we could talk about, but we'll just focus on three things for today. So first is what next for oil prices after Russia's invasion. There's been a lot going on for oil markets, and that's top of mind across a pretty good variety of our client base. Second is COVID-19. We've talked a lot about how it's fading and its impact on the global economy, but it's certainly not gone, and there have been some new developments there. And then finally, we'll talk briefly about the dilemma faced by the Federal Reserve as it takes all of this into account and sets its monetary policy for this year.
Perfect. So the oil outlook has been exceptionally confusing over the past few weeks. Prices have been super volatile. It's not always clear exactly what is driving the numbers that we're seeing. There are big questions about where capacity is, what's accessible. It's become an exceptionally difficult issue and of course critical for companies, especially as it adds to cost of shipping, input costs, and then it spills over into inflation for their consumers. What is your current view and how would you describe what is happening to an executive who is not really deep into oil market forecasting?
Yeah, so I'll start off just recapping what has happened, because even that alone is difficult enough to understand. First of all, immediately prior to the invasion, we were already in an environment of tight oil markets. So you already had Brent crude, the international benchmark, moving from around $90 a barrel into the mid-90s over the course of February. And then finally on February 24th, the day of Russia's invasion, prices jumped past $100 a barrel, and that was for the first time since 2014, after prices had been low for several years. They've since swung wildly. Actually, in a note that we put out to clients on February 24th, we estimated, with tons of uncertainty around that estimate, that oil prices would be concentrated in the $100 to $110 range in the near term, but with potential for tons of volatility and prices potentially spiking up to $150 a barrel. And that's actually considering everything not been terribly far off. We saw prices spike up to a high of $139 a barrel on March 7th, and that was just intraday. So already that day they came back down to $123 a barrel. They've eased quite a bit since then, are now sitting around $100 a barrel. Probably the most immediate reason for that, to the extent that you can kind of ascribe one big factor, is lockdowns in China and the likely impact on oil demand, or the estimation of an impact on oil demand. But there have been a number of factors moving in both directions. So far, a lot with respect to sanctions and self-sanctioning by oil majors. That's been a big factor pushing up price. Pushing down prices are estimations about potential new supply sources. So as we look forward, we're taking into account a lot of factors, and our clients are obviously interested in the oil outlook for quite a few reasons. You've alluded to some of them. A couple more, it's a big input in government budgets, so that it has big implications for B2G demand. It has a big impact on the inflation outlook, as you mentioned, and it's also a big input cost directly for our clients, especially those in the chemical sector. So even despite all the uncertainty, they all want to know, how do we see oil prices faring for the rest of the year?
So that's quite the cliffhanger. How do we see oil prices for the rest of the year? I'm appreciating that it's a bit of a, it's quite risky to make a forecast right now, but talk to us through the assumptions that you've made that will help clients assess what are the driving factors and what might change in those driving factors as we look at forecasts for the year.
Yeah, so it is indeed risky to make oil price forecasts for the rest of the year. We've nonetheless tried. These forecasts are from several days ago, and they probably already need to be pushed up a little bit. They're not wildly far off, as I sort of alluded to earlier. We are obviously expecting high oil prices for the rest of the year. And so despite all the price uncertainty, the main thing we're emphasizing is high prices and volatile prices. And that has been the case for the last several weeks, and it will continue for at least another quarter, probably going into the third quarter. And then as we go on from there, the outlook becomes more and more uncertain. In terms of the price range, here are some of the factors that we're taking into account. First of all, we are expecting more and more of a supply shortfall as we get into the second quarter. Actually, interestingly, the International Energy Administration based in Paris came out with their assessment of the supply outlook for the next couple of quarters, and they estimate that Russian supply will decline by about 3 million barrels a day starting in April. That is a big decline. It's about a 25% drop in production, and they attribute that to sanctions. By the way, all of our estimates assume that the existing sanctions will remain in place for the medium term, so probably for most of the rest of the year, if not longer. With that big supply shortfall, that translates to a huge increase in prices, all else equal. You cannot take out 3 million barrels a day in supply and expect to see, only limited impacts. But there are a few factors that will exert some downward pressure on oil prices. So there is some potential supply recourse, particularly from OPEC, especially Saudi Arabia and UAE. They do have spare capacity. They do have more supply they can bring onto the market, even in a time frame of weeks. There's obviously reasons why they are slow rolling that production increase. But there is a potential for them to bring it online, especially if they're expecting that really, really high prices are going to start to eat into demand. There's also potential for higher US production. That probably wouldn't come to pass until later in the year, but there's actually talk beginning in the United States about potential government interventions in the oil sector. The US government has the ability to essentially temporarily nationalize the oil sector under the Defense Production Act and force more output if it wants to. There are also finance interventions they can make. So those are some of the potential new supply sources. We're also expecting the Iran nuclear deal to likely encourage a little bit of an easing in prices. We're also expecting more releases from strategic petroleum reserves. There's already been some of that. We're expecting more. And then at some point, if prices get high enough, there will be some amount of demand destruction. So for that reason, we're not forecasting $200 a barrel of oil later this year. There will be quite a bit of factors pushing and pulling in both directions. And that's, again, why we're expecting high oil prices and volatile oil prices for the rest of the year.
Thank you. So I know we've been talking about a lot of crisis-related events. Of course, the Russia-Ukraine situation has taken over a lot of corporate attention, but there are other elements of the global economy that are also still playing out. And one of them is COVID-19, which, as we spoke last time, I guess we expect it to be increasingly less disruptive and to be increasingly less impactful for how companies should think about demand planning, operations, etc. Not that it disappears, but that it becomes easier to manage, and as a result, something that is more about ongoing maintenance as opposed to scenario planning or in any way disrupting expectations. Do we still feel this way, particularly given what's been going on in China and Asia Pacific? And if not, then how do you see those implications playing into everything else that we've been talking about, particularly as it relates to shipping disruptions, supply chain disruptions, things that our clients have been struggling with significantly even before any of this took place?
Yeah, so we have seen a bit of developments on the COVID-19 front in the last several weeks. And just to illustrate this on a really high level, we've seen big jumps in cases in several markets in Asia, especially South Korea and Hong Kong, which are now facing waves that completely dwarf their previous waves. That's also translated to actual health impacts in terms of hospitalizations and deaths. We've also seen, obviously, an outbreak in China. However, we still stand by our overall assessment that the demand impact is likely to be less in 2022 than it generally was in 2020 and 2021, that with each new COVID-19 wave, the demand impact is overall less and less. But there are some caveats to that. One is that it's less the case in Asia than for the rest of the world. So due to lesser natural immunity, as well as a reliance on non-Western vaccines, a number of Asian markets are more exposed, and so that's why we're seeing some bad outbreaks there now. It's still affecting a lot in terms of travel restrictions, domestic restrictions, etc. So COVID-19 certainly hasn't gone away in Asia. The second caveat to that, and this is one we've repeatedly emphasized, is that COVID-19 is still likely to pose a significant supply threat for a couple of reasons. One is especially due to the persistence of China's zero COVID policy. Where there are outbreaks in China, and we are seeing them now, China will lock down whole cities and whole provinces in a similar manner to what it pursued in the early stages of the pandemic. And so now China's in the throes of its worst outbreak since the beginning of the pandemic. It's locked down large portions of Shenzhen, and now we're seeing spread of Omicron in Shanghai, and with the introduction of restrictions there. The supply disruptions we've seen so far are moderate, but there's probably greater concern in terms of what's potentially coming down the pike. Omicron will continue to spread. It will continue to spread in Shanghai. And if we see the imposition of a total lockdown there, that will have pretty big impacts on supply chains within China, and that will have spillovers for the rest of the world. We also expect COVID-19 will still matter on the supply side across a number of markets when it comes to labor shortages, due to the fact that when people test positive for COVID-19, they still generally will self-isolate and not go to work. And that has generally been the case. So COVID-19 is kind of fading in relevance on the demand side, and our consumer goods firms especially tend to emphasize that COVID-19 no longer keeps them up at night. But that doesn't mean it's gone and that it doesn't matter. The good news is that our clients are used to a lot of this. They're used to high degrees of demand volatility. They're used to some amount of supply disruption. And we are expecting that, it will be sort of more of the same. We're not expecting a phase shift with COVID. It will be more of the same with a bit less of an impact overall.
Thank you, Elizabeth. One thing I wanted to point out is that a lot of these factors we're discussing are feeding into shipping costs and shipping disruptions. We had an event for our Asia Pacific corporate leaders, senior executives amongst our client base focused on Asia Pacific yesterday. And we asked them how they expect shipping costs to change for their region over the next 3 months. And they expected shipping costs to increase between 25 and 50% in the next 3 months in Asia. And this is from highs that are already massively higher. So some of this related to the Russia-Ukraine situation, some of it related to energy and transportation costs, and of course, some of it related to the concerns around the China lockdowns as well. So this is all feeding into inflation, which takes us into the last topic, and that is what the Fed is going to do about this rising inflationary environment, whether we expect to see more or fewer interest rate increases, and how that might play into global cost of credit. So what is your thinking about the way the Fed is going to look at this issue?
Yeah, so this is a timely topic actually, because as we're recording this, we are awaiting the beginning of the March Federal Open Market Committee meeting, which will start later today. And I'll start off with just illustrating what we anticipate for that meeting, so for the very immediate term, and then going beyond that. For the meeting, it's virtually guaranteed the Fed will announce a 25 basis point increase in the federal funds rate, its benchmark interest rate. We also expect it to make a comment on what it plans to do with its balance sheet, and our general estimate is it will indicate an acceleration in its balance sheet unwinding and then potentially the beginning of quantitative tightening starting in May. That's a bit of an acceleration from what we were expecting earlier and what most were expecting a bit earlier. And it has to do with higher and higher inflation in the United States and the need for the Fed to respond to that. However, we are only expecting a 25 basis point increase. There were some worries about potentially an even faster hike already in March. And it's likely the Fed is slow rolling that in large part because of what is going on with the war in Ukraine. And that kind of gets to the high uncertainty about the outlook for the rest of the year. I'll just illustrate for a second. This is a chart showing the market implied probability of rate hikes in 2022 in the red for the probability of 4 or more rate hikes, in blue for 6 or more rate hikes. As you saw in the lead up to Russia's invasion, there was virtual guarantee of 4 rate hikes in 2022 and still quite high probability for at least 6 rate hikes. So generally market expectations were 4 to 6 rate hikes. And then you saw a big drop as soon as war broke out in Ukraine. And that has a lot to do with the tightrope that the Fed is now walking. We are expecting higher and higher inflation for the US and probably even higher now as a result of the war in Ukraine due to higher oil prices and all the supply disruptions we've been talking about. But we're also expecting lower growth. We at FrontierView have recently downgraded our growth forecast for Europe. We're revising all our other forecasts for most markets, but this is translating to lower growth in the US and globally. So how does the Fed approach a situation where before it was expecting reasonably high growth and high inflation, that marks a confident rate hike path? And now we're facing a bit the stagflation dilemma and the potential as well for financial spillovers resulting from some of these sanctions, which would likely create considerable market volatility and the need for the Fed to intervene to help stabilize the market with insertions of additional liquidity. So the Fed is factoring all of this in. It underscores a generally very uncertain outlook. Our view is a bit more dovish than what the market is expecting, probably more like 3 to 4 rate hikes due to the fact that the Fed will need to tread very carefully with its rate hike path.
Thank you, Elizabeth. I think all of that highlights the importance of some of the actions we've been discussing with our clients. Some of it, of course, related to scenario planning and really understanding how the global environment might evolve over the coming months. But very clearly, there's going to be a significant challenge in terms of cost structures and pressure on margins. Previously, companies had expected to pass through price increases, significant price increases onto their customers. Now we are starting to have concerns about demand destruction, significant trading down, and the potentially loss of market share, especially given that the additional costs will also have to be passed on. And so our recommendation for companies is really to rethink their segmentation, understand the price sensitivity of the different groups and geographies that they're looking at, and ultimately, I think we're in a place where significant thinking about supply chain structures is going to be necessary. There's too much pressure on the current system, and it's been going on for too long to assume that structures are going to stay as they currently are. We would probably see a wave of restructuring of supply chains over the next couple of years stemming from this moment in time and some of the pressures. But in the short term, companies still have targets to hit, and they need to find the customers willing to take higher increases in prices, potentially with a refreshed value proposition, with a better service model, with strong partnership from local distributors and dealers to really help maintain commercial performance as companies went into the year with fairly high and optimistic expectations. So if any of this resonates, let us know. We're happy to discuss resources to support you in it. And I'm sure we'll be back a month from now with a lot more to discuss. Hopefully some good news at that point, rather than just challenges. Thank you, Elizabeth, for this conversation, and looking forward to seeing everybody in a month.
Thank you.